So if we draw to maybe a sort of a brief history lesson then in your experience, AB, and really 3 events come to mind. The 89 crash.
There might be for you, there's a lot more than 3.
Yeah, 3 big ones.
What have you highlighted?
3 big ones. The 1989 crash, the GFC, and COVID. And I remember going through COVID as a trader here, and that was scary.
I'll tell you a bit about some of these. So the 87 crash.
87 crash.
Was a couple of months after I'd made my first investment in the stock market.
Poor thing.
And I got hosed. So that one is a very vivid scar that's still on my back. Probably dollar-wise would have been one of my smallest losses ever as an investor.
What caused it?
The 87 crash I'll get to in a moment. The dollar loss in itself was probably the biggest dollar loss, smallest dollar loss I've ever made, probably biggest percentage, because I wiped pretty much my whole account out with that. It's about £500 or £300 or something like that, which is nothing now. But nonetheless, great learning lesson. That's why I'm so fastidious on teaching risk management, because my very first investment was very much a nosebleed and probably a fractured jaw for me. So we had a sell-off in the US, as always, and that then kicked over into the UK. And what actually happened in the UK, there was a, for want of a better description, a hurricane. I don't think you get hurricanes in the UK, but whatever it was inclement weather, blew a heap of trees over. So a lot of the railway lines were shut down. There was a lot of debris on the rail tracks. So a lot of traders that back in the day would live in what was called the stockbroker belt, which is Surrey, Essex, places like that, and coming into the city to work. So they couldn't come in on the Monday because the weather was too inclement. So they came in on the Tuesday, a day later, which exacerbated the crash. How fun is that? Whereas these days, of course, work from home, you'd be trading from your system at home. There wasn't even internet trading then. So that dates that story. So the 87 crash was an absolute ripper. If I look through the 90s, 97, you had the Asian currency crisis. Russia defaulted on its debt. 99 or 2001, you had the dot-com correction, which was dramatic and took the Nasdaq 15 years to recover from. But the initial sell-off was over a period of about 4 days, which was brutal. Bang, 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 4 days of down. And as you say, you then go through and look at the GFC in 2007, or indeed the COVID correction of 2020, and they're quite some distance apart. Those big corrections that people are nervous about, the stock market could crash or correct, they're always quite some distance apart time-wise, usually a decade or more in some instances between them. But all of them have a very similar DNA. They didn't happen overnight. If you look at the charting, you could see that markets were looking very, very toppy. And you start to get either a rounded top, or you start to get some basic charting analysis, some lower highs. So there's a period of notification saying, look, this market looks like it's run out of puff. You probably should be a little bit careful here. And then bang, the sell-off happens. And what happens in that scenario? People think, that was overdone. There's no way it should have dropped 20%. It'll recover tomorrow, and it's down another 10 tomorrow. It becomes very expensive. So first cut's always the cheapest. Get out early, hit the exit, done. Or buy protection, which I'm sure we'll get on and talk about. So
let's do that. You talk about being fastidious on risk management, and I totally see why. What springs to mind, when you talk about risk management for investors out there?
Look, there are a number of different layers that you can put in play. A stop loss is a must, I would say. The difficulty you have in very volatile markets is that a market can trade through that stop loss, giving you a gap, so it exacerbates your loss. Still better than holding on while it's plummeting, but nonetheless you can make a bigger loss. I guess in the broking industry, we've got a lovely term for that softens it. Just because you've made a bigger loss, it's just slippage. It's not just slippage; it hurts when it's your money.
Oh, yeah.
So stops are one way that you can put things in play. Buying protection through options, so buying some put options, for example, to protect yourself if your view is the market's looking pretty toppy. There's no point buying insurance after the event. If your house is burnt down, you can't go and buy house insurance. It's too late. Flood insurance after it's flooded, too late. So these are things you need to do prior to the event. I guess hedging is another way, a little bit more sophisticated, and I think we can tie that in quite nicely to volatility as we get on and talk about perhaps the VIX index in a few minutes' time, whereby you take the opposite side of the trade, or a portion of your portfolio is positioned on the other side of the trade. So if you've got a blue chip portfolio that's looking to make money when markets go up, maybe buying a bearish ETF gives you some ability to profit from a bearish market. I think it should be pointed out that if you hedge, you're not going to make any more upside, but you're not going to make any downside. It's just going to keep you positioned pretty much square. which obviously is better than being underwater with it, but it does restrict your upside ability, because if the market keeps going up, you're going to lose money on your hedge. So, they would be the main things. Diversification, of course.
Sectorial, you mean?
Sectoral,
so more defensive.
Different types of instruments. So you can have some equities and bond exposure in the same portfolio to give you a little bit of diversification in there as well, are ways to sort of tiptoe around that.
So they're the risk management tools, but probably the hardest part for investors is the psychological, the mistakes that we see during the volatility, but most importantly, after the volatility. A couple spring to mind is that negative bias. So because it's happened in the past doesn't necessarily mean it's going to happen in the future, but that's the way that we're wired, right?
Absolutely. Human nature is such that, we expect the same thing to happen over and over again, which, the one thing we learn from history is the fact that we don't learn from history. A bit of a profound comment, but nonetheless a truism. And that psychological bias in times of panic is huge. As I say, when you can really see the whites of someone's eyes, and I appreciate that sounds quite dramatic, but having been on trading floors when there have been corrections, and as a trader, if you're just clipping the ticket on the way through and you're filling orders for a fund or a bank, it's not your money. But you can still see that fear across the face of traders under those circumstances too, where that sort of red mist has come down and it's panic that's really setting in. And in actual fact, it's a time to be very measured as to what you want to do. So how do you combat that? It's all right talking about it, but how do you actually combat it? And I would suggest for everybody that's invested in markets, making decisions in the heat of the moment is just about the worst thing you can do. To give you a very simple example of that, if you're in a relationship and hypothetically you've ever had an argument whilst in that relationship, chances are you might have said something you've regretted.
Many times.
But once it's said, you can't undo that. But it was said in the heat of the moment because it was highly emotionally charged. Trading can be just the same. So one of the best ways of protecting yourself from making those rash, emotive, red mist decisions is to have a plan before you get into the trade. So before you enter into a position, this is what I'm going to do if this happens, this is what I'm going to do if that happens, and this is what I'm going to do if the brown stuff hits the fan. So you've got a detailed, written down plan that you're committed to. And so if and when any of those events happen, you simply revert to what your plan was and execute it. It takes a lot of self-discipline to do that. But you made those decisions before you were in the trade. And the reason you need to do that is once you're in the trade, one of the emotions that you can bring through, it's a psychological condition, it's called the endowment effect. So when you own something, you feel very different about it than if you didn't own it. If it's something that's not yours, you're very objective about it. When it's yours, you can be quite emotive. So before you get in the trade and you don't own something, this is what I'm going to do. BHP, I'm going to buy it at this price. If it gets to there, I'm going to take profit. But if it drops to that, I'm out. That's a really simple 3-point business plan. All you got to do is execute it now. Sounds easy, right?